stop. Before you open your brokerage app again and hit buy on another ETF, listen to me for exactly 1 minute, just one. And if after this minute you decide I'm wrong, close the video, go buy your favorite index fund, no hard feelings. But I'm almost certain you'll stay. Because what I'm about to tell you isn't another life hack from a financial coach with a fancy car in his profile pic. This is concrete math, real historical data, and very uncomfortable conclusions that major fund managers prefer not to discuss with retail investors. I know you've heard this advice 1,000 times. Buy the S&P 500, hold for 20 years, get rich. Buffett says it. Your dad says it. Every financial blogger selling you a $50 course says it. But here's the question none of them ask out loud. What if the S&P 500 today is not the same tool it was 20 years ago? What if a trap is hiding behind that beautiful, smooth graph? A trap millions of trusting investors worldwide have already fallen into. And most importantly, what if right now there's another index? Less famous, less hyped, but significantly more interesting in the current climate. Its name is Russell 2000. Remember that name. Today, I'll tell you everything they've been intentionally hiding from you. Let's go. All right, enough about problems. Let's talk about the solution. The Russell 2000 and why most retail investors either never heard of it or unfairly ignore it. The Russell 2000 tracks 2,000 small and mid cap American companies, construction contractors, regional banks, medical clinics, manufacturing plants, logistics, startups, local retail chains. It is a living cross section of the real American economy, the one they don't show on Forbes covers. If the S&P 500 is a closed club of corporate oligarchs dividing the market among themselves, the Russell 2000 is the arena where you can still find hungry players with massive growth potential. Now, the numbers. The average market cap of a Russell 2000 company is 2 to 3 billion dollars. Apple is worth 3 trillion, a difference of exactly 1,000 times. And yes, the first reaction is predictable. Why do I need some unknown small fry when I have Apple? I'll answer mathematically. Apple will never double in value again. It's structurally impossible. For Apple to double, it would need to be worth $6 trillion. That's more than the combined GDP of Germany, France, and the UK. It's not happening. But a company with a $2 billion cap, it can double in one strong year, grow 5 times in 3 years. This is where real capital growth potential lives. Mathematically justified, not virtual. And here's the detail investors almost always overlook. The Russell 2000 is almost exclusively the domestic American economy. About 80% of aggregate revenue is generated within the US. No currency risks, no dependence on the Chinese yuan or European central bank decisions, no geopolitical seesaws, no complex supply chains spanning half the globe. The Russell 2000 is a pure, direct bet on the American consumer, American workplace, and American manufacturing. And right now, as the world discusses reshoring and bringing manufacturing back home, it's exactly small and medium businesses winning this trend fastest. While Apple builds another factory in India, a small steel manufacturer from Ohio quietly lands a 10-year government contract, and nobody has noticed their stock yet. 3 concrete problems. I'll break down each one in detail because this is exactly where most investors make fundamental mistakes. Problem 1, geopolitics. Trade wars, sanctions, tariffs, and armed conflicts have become not the exception, but a constant background reality. Every time tensions between the US and China escalate, the tech giants in the S&P 500 start nervously ticking downward. Nvidia loses tens of billions in market cap due to chip export restrictions. Apple watches as the Chinese government incentivizes purchases of domestic smartphones. Amazon sees its trans Pacific logistics chains falling apart. Now, take a typical Russell 2000 company, a construction firm from Texas building warehouses for local retailers, a regional bank from Florida lending to local farmers and small businesses, a brewery from Ohio selling beer in neighboring states, a medical center from Georgia accepting patients through insurance. Do they sell anything to China? Do they depend on Taiwanese semiconductors? Does their operational activity suffer from the geopolitical seesaw between Washington and Beijing? No. Geopolitics is an existential, systemic risk for transnational giants. For local small businesses, it's noise in the news with zero impact on their revenue. Problem 2, valuation and multiples. The S&P 500 is trading at historically high levels relative to actual company earnings. The index PE today is around 25. Historically, the normal range is 15 to 17. The market is trading at a 50% premium to the historical norm. What does this mean for you personally? You are overpaying. A massive, unjustified premium for brand recognition and the illusion of safety. And overpaying in investments is a mathematically guaranteed lower return in the future. This isn't an opinion or a forecast. It's arithmetic. High interest rates act like gravity, especially brutally for expensive growth stocks with high multiples. When money is expensive, everyone suddenly starts calculating what a business is actually worth here and now, not based on optimistic forecasts 20 years down the line. Problem 3, the illusion of diversification. 35% of the index is concentrated in 10 companies. Imagine something serious happens to Apple. A major regulatory fine in the European Union for tens of billions, a manufacturing defect in a new line of devices, a significant loss of market share in China, a disastrous product presentation. Any of these scenarios is entirely realistic, not science fiction. Your broadly diversified portfolio drops several percent because of one company, one board of directors, one operational decision. That is not diversification, that is a concentrated bet, cleverly disguised as a broad index of 500 positions. Problem 3, the illusion of diversification. 35% of the index is concentrated in 10 companies. Imagine something serious happens to Apple. A major regulatory fine in the European Union for tens of billions, a manufacturing defect in a new line of devices, a significant loss of market share in China, a disastrous product presentation. Any of these scenarios is entirely realistic, not science fiction. Your broadly diversified portfolio drops several percent because of one company, one board of directors, one operational decision. That is not diversification, that is a concentrated bet, cleverly disguised as a broad index of 500 positions. The Russell 2000 is an index tracking 2,000 small and mid-cap American companies. Construction contractors, small medical clinics, regional banks, manufacturing plants, agricultural holdings, logistics startups, retail chains with a presence in a few states. It is a living, breathing cross-section of the real American economy, the one they don't show on the covers of Forbes. The average market cap of a company in the Russell 2000 is about $2 to $3 billion. Apple is worth $3 trillion, a difference of exactly 1,000 times. And the natural question arises, why do I need some unknown small fry when I have Apple with its billions of users and flawless reputation? I'll answer mathematically. Apple will never double in value again. It is physically impossible. For Apple to double from current levels, the company would have to be worth $6 trillion. That's more than the combined GDP of Germany, France, and the UK. It's not going to happen. But a small company with a $2 billion market cap, it can double in one strong year, grow 5 times in 3 years. This is where real, actual capital growth potential lies. Not virtual, but mathematically justified. And the key detail, the Russell 2000 is almost exclusively the domestic American economy. About 80% of the aggregate revenue of all companies in the index is generated within the US. No currency risks, no dependence on ECB decisions, no complex transcontinental supply chains. It is a pure, direct bet on the strength of the American consumer and American manufacturing. And right now, as the entire business world discusses America's industrial renaissance and reshoring, it's exactly small and medium sized businesses that are winning from this trend faster and more noticeably than anyone else. Three powerful catalysts have aligned simultaneously. Such a confluence of circumstances is rare, and when it happens, the investors who manage to notice it before the crowd make truly serious money. Catalyst 1, the reversal of the interest rate cycle. For the past 2 years, the Fed conducted the most aggressive rate hike policy in 40 years, from historic 0 to 5.25% in less than 24 months. And it hit small businesses hardest. Smaller companies rely significantly more on debt financing than transnational giants. Apple holds nearly $200 billion in cash. High rates are practically irrelevant to them. But a small construction company with a variable rate credit line or a small manufacturer financing working capital through a bank loan, they felt the hike instantly and very painfully. But the cycle is reversing. The Fed has started cutting rates, and historically, this exact moment, the very beginning of a new cutting cycle after a prolonged period of high rates, is literal rocket fuel for the Russell 2000. Every single time in documented history, when the rate cycle reversed downward, small caps outperformed large caps by an average of 15 to 20% over the following 12 months. Not once. Every single time, without exception. Catalyst 2, valuation, a historical gift. The S&P 500 PE is 25. The valuation gap between the two indices is now at its widest point in 20 years. This means one simple and very valuable thing. You are getting more real American business for significant. Option 1, ETFs. The most popular instrument is IWM by iShares. It tracks the index practically 1-to-1 with a fee of around 12 basis points per year, literally 0.12%, available through any broker with access to the US stock market. A direct alternative is VTWO by Vanguard, with an even lower fee and comparable liquidity. If you have a long-term investment horizon and simply want broad exposure to the entire asset class, either of these two ETFs completely solves the problem. Option 2, sector ETFs. Regional banks look especially attractive right now. They directly benefit from rate cuts through cheaper funding and increased credit demand from local businesses. The small cap industrial sector is a clear beneficiary of reshoring and infrastructure spending. Option 3, individual stocks. Inside the Russell 2000, it is realistically possible to find absolute gems, companies with clean balance sheets, growing revenue, positive cash flow, and laughable multiples. Analysts at major investment banks simply don't write detailed reports on them. Not enough commission potential. This is information inefficiency that a retail investor can use to their advantage. Risk management. Small caps are not a replacement for the S&P 500. A reasonable allocation for most investors is 20 to 30% of the portfolio in small cap instruments, while maintaining a core position in the broader market. Enter gradually, in several steps, and use pullbacks as buying opportunities. The market always gives a better entry point to those who have patience and a pre-planned strategy. Let's sum it up. Short, hard, and to the point. The S&P 500 is not a bad instrument. It is a good instrument that was magnificent 20 years ago and has ceased to be the optimal choice exactly right now. It is bloated with transnational corporations carrying increasing geopolitical risks. It trades at historically inflated multiples that mathematically limit future returns. And there is no real diversification, just a beautifully packaged illusion. The Russell 2000 is not a silver bullet. It is a concrete, justified tactical opportunity opening up right now due to a rare alignment of factors: a rate reversal, historical cheapness in valuation, and a massive domestic economic boost through reshoring and government spending. Investors who noticed a similar window in the early 2000s made 40% while everyone else sat at zero. Those who noticed it at the end of 2020 doubled their money in 4 months. History is not obligated to repeat itself, but the numbers, the market structure, and all three catalysts are speaking with one voice right now. Windows like these don't stay open forever. They close the moment everyone around starts talking about them. Right now, not everyone is talking about the Russell 2000. Right now, I am talking to you about it.